We occasionally get asked if our indicators work with Renko hybrid charts, Unirenko, SI Pro Renko, all the different kind of Renko hybrid charts. And yes, they do, but I wanted to make a video about this and show you why the information that you're getting out of most indicators on Renko charts is really just pretty useless. Renko charts' main function seems to be strictly for market structure and wave counting and maybe a couple of other uses. But if you're putting moving averages, but if you're trying to use volume indicators or any kind of indicator that needs to use the ranges of the bars as an input, then the data that you're going to get out of those indicators is going to be skewed. So the main issue with the Uni-Renkos, any type of Renko hybrid chart, is the fact that the open is offset. And what you are seeing as the full range of the bar is really not necessarily the range of that bar. Price may never have come back the full length of this bar. You can see that here it absolutely did, and then it came back even further. But on the next bar, it may have only moved one tick, and then another tick to the next bar, and another tick to the next. And it has to actually move through the high of a bar for that bar to close. So this bar's true close is really the high of the next bar. So your data points are essentially imaginary. You have a false open, a false close, it's one tick off, and the low of an up bar does not necessarily represent the actual range of that bar. So when it comes to trading, your most important thing that you have is data. And with the Renko charts, you're immediately starting off with altering that data. You're changing the data, and you're making the open, high, low, close potentially just completely imaginary, depending on whether it's going up or going down. Like I said, if the bar is going up, the low is potentially a false low, unless it has a wick. And when it's going down, the high is potentially a false high, unless it has a wick. Like for instance, right here, this bar actually moved to the high that's represented there with that wick. But on the next bar, you have no idea how far price actually came back within that candle. And the thing with the volume indicators is we're using the range of the bar to determine the type of paint bar condition that we're getting. So for instance, here on the right on the tick chart, this is a 240 tick chart of the 6E. Right here at the low, at the ultimate low of today so far, we have what's called a strong climax bar. We're having one right here on the far right edge of the chart. So if I bring this over to that low, you can see that we have both a major spike in the volume and a strong climax. We're using the range of the bar as well as the volume to determine those paint bar conditions. Here at the high, we have a churn bar, so that's very high volume per range. And we also have in the indicator above, very high volume per second. That's what this dark pink kind of a histogram bar represents. Very high volume per second. Okay, so the range of the bar, the time it takes to create a bar, and how much volume we're getting relative to the size of the range of the bar is all very important information. And that's what these volume tools were designed to find. So when you take that and then put it on a Renko chart, many of whose bars will be simply one tick bars depending on how you've got it set up here, but we have a one tick trend, 8 tick reversal, and then a 3 tick open offset here. So some of these bars are potentially just one tick in range. So we can't really expect the paint bar conditions that are created from the ranges of the bars relative to the amount of volume per bar to be accurate whatsoever. And then the volume spike conditions. So for instance, this is a minor spike here. That's an extreme spike at a high, and then this is a major spike. The data that you're getting is just simply not accurate, because any bar that has a wick or any reversal bar with the Renko charts is going to have higher volume than one of the bars that maybe only has about a tick or two for the range of its bar. So you'll be getting a lot of these extreme spike, major spike, minor spike conditions on bars that are not necessarily important bars at all. So what we're attempting to do is to try and find the ends of corrections or the end of a trending move. We're trying to find areas in the market where price is likely to reverse. If it's going down, to reverse back up. If it's going up, to reverse back down. So we need information that is as accurate as possible. And the Renko style charts just really don't give us that kind of accuracy that we need for these types of indicators. For instance, look at the balance momentum here in the subpanel. This is the divergences pro indicator to try and find bearish divergence at the highs and bullish divergence at the lows. You see how skewed the balance momentum indicator is here? This is not a true representation of price action momentum that's being developed in the market. So the fact that you have a couple of divergence signals here that then turn into reversals, the market actually reverses out of those two bearish signals here, that's purely happenstance. because in fact there isn't any true representation of momentum here. You have several bars straight up here, and then you have some bars straight up here. There's a fewer number of bars back up than there was for the initial push, and the same can be said for this swing back here. But that doesn't necessarily mean that there's waning momentum into that high. You would have to actually look at a minute chart or a tick chart to see if price action momentum is actually waning into that high. So the Renkos aren't going to give you a good depiction of true price action momentum. They're not going to be useful for using volume or volume per second or trying to access the paint bar conditions out of the volume, for instance, for the churn, which is very high volume per range, or the climax bars, which are very high volume, high ranging bars. You're just not going to get the level of accuracy that you need to use these indicators properly and in a way that actually serves to improve your trading. Now, that's not to say that these Renko hybrid style charts are not useful. Like I said in the beginning, obviously they're very useful for counting waves, defining market structure, for applying, Fibonacci analysis, Elliott wave, things like that. But when it comes to actually using any sort of technical analysis indicator that has anything to do with volume, range, or momentum, all they do is skew the data, and your data is the most important thing that you have. So just a couple of more things here. We have a 5-minute chart, and we're looking at relative volume and relative density behind that. I know it looks a little messy, but what we're looking at here is relative volume. So it's not the true volume or the volume per tick. We're actually looking at the average volume for each time period. So the relative volume and density is best applied on minute charts so that you can perform that calculation for the average volume per time period and then determine how much relative volume per range that we have for each bar. And here we have an extreme spike at the high. It's also a churn bar. It's very high relative volume per range, showing us that supply is coming into the market here. Then we have a sign of weakness, and we're going back up on waning momentum into these highs. So once we start breaking this prior high, you can see the little resistance line there. Let me turn off the divergence indicator. You can see the resistance line there. Once we start breaking above that on waning volume, less volume, then we're starting to put in these volume divergence signals. And one of the main things that we use for determining the areas that we're trying to trade from is market geometry. And the market geometry really is most accurate on minute charts and tick charts. You will get different areas between minute charts and tick charts. Just to show you the differences here, I'm connecting the low last night to the low this morning in the 6E. And I'm bringing it back to the bar after that wick. So I try to eliminate those big wicks. And that's giving me the high here. And then I connect from low to low, and that gives me the highs here. So we break through the channel, top of this channel a little bit, and then we come up to the center median line. And they're both kind of intersecting right there on a volume divergence signal. And then likewise on the tick chart, I'm connecting low to low here, and then bringing that back to the lower high. And that's coming in here. And then connecting low to low here, and that's coming in perfectly right there. Also on volume divergence, you see we have these extreme spikes in the volume here. We also have a churn bar. We have very high volume per second at most of these little swing highs and lows. Very high volume per second there, and then very high volume per second here, which is actually where I ended up getting in. After seeing that really fast push out of this high, I put in a limit order, get filled, and then watch it run down for about 85 ticks. Just one contract. So when we try to define those same areas in the market geometry using the Renko charts, when we're doing it on faster, shorter time periods, it seems to work pretty well. But when we start including more and more bars and look across a much longer time period, then it just doesn't add up, and we're not presented with the same very important areas in the market geometry that we would see on the minute and tick charts. So while the market geometry may appear to work pretty well on short time intervals with the Renko charts, the longer back you look, the worse and worse the skewing of the data becomes. So I just wanted to make a video about that. We get asked about that quite a bit, and I always kind of just, give a quick little explanation as to why I think that they're not so useful for the type of analysis that we're doing, especially when you're, like I said, trying to use the ranges of the bars to perform these calculations, and you're basically just skewing the data. While they're not good for this type of analysis, I think they're very useful for counting waves and looking at market structure and applying fibs and stuff like that. But for the way that we're trading with the volume, we need to have minute charts, but we also need to have tick charts so that we can look at the volume per tick and find these areas where we have a very high number of contracts coming in per tick. So we're able to see, kind of both angles of this, how much volume per time period, and then how much volume relative to the number of transactions that are coming in. And having both of those, and see, this is where I got out right here on this huge amount of volume that came in, only to watch it keep going a little bit further. But when you see that amount of volume come in at a low, it's typically a pretty good place to get out, especially after such a nice strong run down with 5 waves down into that low. So to be able to have the volume on the minute charts, the relative volume and density especially, and then the volume per tick on the tick charts with the volume per second, and see how fast the volume is actually coming in, relative to the size of the ranges of the bars and how much volume per bar, hence how much volume per tick, getting a true depiction of the actual price action's momentum on the tick charts and the minute charts. So we can see at this high where I got in, we had waning momentum into that high, we had volume divergence. Price action is essentially just kind of overlapping and going sideways into that high. We come up and we hit the areas in the market geometry, and then we get that pop with those reversal bars coming in very, very quickly. And then I put in my limit order, it gets filled, and then I ride down to the bottom of the channel. The Renko bars just really aren't going to give you that level of accuracy, but again, they are, pretty useful for counting waves, but that would be all that I would use them for. But if you think you may want to try them out with our indicators, that's fine. You can go ahead and do that, but you're going to have a lot of signals all over the place. Depending on how you set up these Renko bars, you can change the look of them and kind of make them more like range charts. And, the indicators do work fairly well on the range charts. But again, to be able to have that volume per range and the volume times the range for the paint bar conditions, you're not going to be able to access the paint bar conditions for the range charts either, because every bar has the same exact range. So while the range charts may be a little bit better for what we're trying to do, they're still not going to be as good as the minute charts or the tick charts, which actually give you 2 different ways of looking into the volume and the range and the density of the volume, how much volume per range, and to be able to see those buying climaxes and selling climaxes much more effectively and accurately. So that's kind of the long version, the long answer to why we don't use Renko style charts, nor range charts. They're going to be better for analyzing volume than Renko's would be, but still we focus mostly on tick and minute charts for those very specific reasons. So if you have any further questions, don't hesitate to write in to support@tradetheplan.com, and we'd be happy to answer those for you.